Good morning. It's June 10th, Friday, and it's 6:29 a.m. Been a while since we did a recording in the morning, and thank you for joining us. Welcome to episode 46, Market Chill. Good morning to you, Wowie,
Morning, Mark.
and good morning to our listeners. So I hope everyone is doing just fine. This is your host, Mark Yu,
And Wawi Santos.
and welcome to the Mark Yu and Wowie show. So, just a disclosure, this show is made for sharing information purposes only and not to be considered investment advice. I and Wowie are both physical therapists here in the USA with a passion and interest in researching and investing our hard earned money in the stock market. To our coworkers in the medical field, thank you guys for your hard work. So, for those who have missed it, episode 45, our previous episode, we discussed the contrasting market outlooks, positive stock fund flows, real estate slowdown, and Costco's earnings report. Also, we roll the clip segment. We have Larry Fink of BlackRock's, one of the world's largest fund managers, and Howard Marks, one of the most tenured Wall Street figures around. So, for those who have missed it, you can go back to that previous episode and see and listen to our previous recording. So, for this week's episode, we're gonna jump on quickly to our weekly review of the stock market sentiments. So we always go run through the American Association and Individual Investors survey. So they conduct this on a weekly basis just to monitor what is the investor sentiment. Are they bullish or bearish or neutral? So bullish meaning they think the stock market will go up in the next 6 months. Bearish um, is just the contrary standpoint from bullish, and self-explanatory is neutral. So for this week, June 8th, as of June 8th, there are a lot more people that are bearish or think that the stock market will go down in the next 6 months. It grew or it rose from 37% to 46.9%. So almost 10 percentage points up for the bearish investors, while bullish lost 11%. So a lot of people are getting more bearish so far this week, Wowie. What do you think?
It's a downshift from last week. So last week
Mhm.
we had experienced a rise in Nasdaq of 2%, and now this week we are on
Right.
the downtrend again, awaiting the CPI data.
Right. Everybody's holding on. Well, today is Friday morning, so we're gonna see the report of inflation. CPI data is Consumer Price Index. So we're gonna see the report later on this morning, and hopefully it kind of meets market expectations. So we don't expect any like significant sell-off again in the market. Me and Wally were just talking earlier before we started recording that yesterday was kind of like just flattish reaction in the stock market. In the last hour, just incredible selling pressure. Each and every sector was actually down yesterday at the close. So something spooked the market just before closing. It could be that everybody's just trying to see what's going to happen or trying to be defensive for this morning's report, inflation report. Or what I'm thinking is maybe because of the European government now joining the hawkish stand, or hawkish meaning that they're more into hiking or increasing their interest rate to slow down inflation. So, so for those who are not aware, yesterday, the European government came out with a decision that they're going to hike up rates today and on this month and on their next meeting, which is on 3 months from now, July, August, on September. So that's something to keep an eye on. It means that
Mhm.
while despite the turmoil, European stocks actually is cheaper at this point in time compared to the U.S. Still, because of the inflation, they decided to go hike up their rates regardless.
I will watch Asia Pacific area as well
Mhm.
if we're gonna watch Europe.
True. So Asia, we've been slowly seeing some bounce back. For those who are following, for example, China specifically, I think their index is up. If you're gonna take a look at the K-Web ETF, so that kind of reflects the Asian market. They're actually down yesterday, nearly 7% to the close. That's quite a sell-off. But right now,
Mhm.
pre-market before open, they're up 3.3%. But if you look at their performance since last May, they're up nearly 27% as an index. They're in the bull market right now. Anything that jumps more than 20% in a certain amount of time period warrants an indication that they're back in bull market after their incredible sell-off from last year. So that's one thing to keep an eye on. I think Alibaba is up like back to its $100 figure per share, $109, $110 a share. So they're up almost 3.6% pre-market. But if you're going to look at year to date, they're down 8.7%. So not so much negative compared to the overall S&P 500, but Alibaba is slowly recovering.
Mhm.
So let's look at the fear and greed index. So we're still at fear. We're at 31, whereas just last week we are 27. So more fear hovering around, probably because of what we said, the inflation report. And now we are seeing European government trying to curtail inflation through hiking their rates. Market momentum, we are looking at extreme fear still compared to last week. This is the S&P 500 index versus its 125-day moving average. So right now we're still on extreme fear compared to that moving average. So once the index goes up or crosses that average, we're gonna see at least some bullish sentiment going in. At this point in time, we don't see such action. Stock price breadth, which means that it's a measurement that looks at the volume of shares. So if it's rising, that's a bullish sign. But if it's declining, that's a bearish sign. So because of, like what we discussed previously in the episode, summer months or June, July, this is when, big wigs of Wall Street, hedge funds, managers are taking some time off, enjoying their summer breaks. So there are a lot less orders coming into the market. Still, that doesn't exempt the market from any volatility or up and down movements. But it's more, what do you call it? It's more magnified because there are a lot less people trading the market. Therefore, less market makers, less people trying to match orders. Then there's more fluctuation as a result. So stock price bet at the moment is at its lowest in for the past year. So that's indicating kind of like fear as well. Put call options, we're seeing still elevated measurement since a year ago. So people are still buying puts, trying to protect their portfolio in case the market goes down. They're gonna profit. It's a good bet. But I myself don't do put and call options. Do you do that, Wawi, or
No, I don't. I don't do options. Although I'm ready for options if I ever get into it.
right?
Um, is I just don't know a whole lot about it, so I don't get into it.
Yeah. Likewise, it's kind of a bet thinking that the market will go down or go up in a short time period or in a specific date. So it's kind of difficult to do such compared to when you're doing an investment for the long term. Like if you intend to hold a stock for more than a year, it's easier to just bear the downfall if it goes down or buy more even. And then, if it goes up, it's up to you if you want to hold it or sell it. Market volatility or VIX compared to its moving average. Interestingly, what we've been seeing this VIX neutral despite the sell-off.
Mm,
So that's one thing to keep an eye on. Like for the past 5 days, for the past week, volatility
okay.
is up just 3.6% to 26.64. So whenever this gauge or instrument goes above 30, it kind of signifies or indicates that there's a fear like pushing
Mm.
behind it. There's a wave of people fearing the more fluctuation in the market. But so far this week, it's just up 3.6%.
It's
So
a
we're
good indicator. It's a very good indicator. That and leverage S triple Q.
Uh-huh. S triple Q is like short a Nasdaq, right?
Yes, it is three times short of S&P 500.
Oh, that's quite a
It's
leverage.
yeah, it's a sensitive indicator too when it comes to the market.
Right. Well, for the past week, if we're going to take a look closer to the indices or industries involved in the stock market, only one sector is on the green, and it's no other than energy. It's up nearly 1% for the past 5 days. Right now, oil, as we are going to see in a little bit, it's its highest for past, I think, at least decade. We're at 120 barrels per barrel. $120 per barrel. And
Mhm.
I think JP Morgan came out with a prediction that it'll reach $150 per barrel.
Yes.
So that's gonna even push up our inflation numbers. But we'll see how the report comes in this morning, as we have already discussed in our previous episode that the housing demand
Hmm.
has started to slow down, and that application have actually declined, not
Hmm.
seen for the past 22 years. So there's some kind of like offsetting in terms of the Fed rate hikes, resulting to higher mortgage rates, resulting to buyers um, postponing their plans on buying houses. So at one end, the Fed is able to address inflation, but because of the war that's ongoing, we're still seeing higher oil prices.
Yeah,
Since this,
another indicator on my screen
mhm,
is the flattening of the yield again. It was playing around 29 to 30 basis points on
uh-huh.
the 2-year, 10-year yield, and now it's like at 18.
Oh, it's going
So
flat again. Wow.
it's going flat again in just a day.
So yeah, if, for those listeners that are not aware, I think we discussed this some point in March or no April, when we first saw the inversion of yield curve, and that kind of triggered a sell-off too, right, Wowie?
Hmm.
Of the stock
Yeah.
market. Even no, this is probably around February when we first experienced the yield curve this year. Let me make sure. So
Yeah,
at
and
one point,
there's
it was really trending. So April 25, when we saw no, not that's not right. There were like surging headlines about recession when the yield curve turned negative sometime this year. Uh,
yeah, just a few months ago.
yeah.
So it's trending, flat again, and ahead of the CPI data. But I think they already know what the data is going to show. There's some that are forecasting it to be like double, like at 0.7%.
Wow.
Yeah.
Well, we'll see. Hopefully, it plateaus soon. That way, we feel a
Hmm.
little bit more relaxed in terms of the Federal Reserve stance in terms of raising interest rates. So since
Hmm.
the start of the year, no one else have returned positive to their shareholders except for energy. It's up 45%, and the rest is down in the red, led by consumer cyclical, which is down 26%, technology 26% in the red, communication services down nearly 25%. So we're gonna see the actually we have a treat for you guys today. We have the valuation for these industries, just to see like how are they faring against the overall S&P 500, if they're cheaper or if they're still expensive. So if we're gonna look at the S&P 500 index alone, we're looking at the forward PE ratio. This is a forward-looking measurement for the next 12 months. So the S&P 500 alone, this is according to Yardeni Research. They published this on June 8th, so a couple days ago, still fresh. So S&P 500 alone is 17.3 times, whereas financials, they're at 12.4 times, very cheap compared to the index. Consumer staples, they're still expensive compared to the index at 20.3. Healthcare 15.9, cheaper than the index. And here we go with the industry that had a huge sell-off so far this year. Information technology, there's still 20.7% or 20.7 times earnings. So they're still pricey at this point in time. Consumer discretionary, which is the huge underperformer in the industry so far this year, they're still 23.3 times. So you can see the dip actually since the start of the year. They're just going down, down, and down. But compared to their history, they're still a little pricey. They're pricey compared to their 2007, 2008 levels. So I'm not saying that there are more sell-off coming on the sectors consumer discretionary and information tech, but hindsight is 2020. So we'll see if we see any floor on terms of their performance. But so far this year, they've been very huge disappointment to their investors. Communication services, they're at 15.5 times cheaper than the S&P 500. Utilities, interestingly, it's more expensive than the overall S&P 500 at 20.6 times. Probably Huawei
Mm.
because of their certainty, right? They're like what do you call that? Recession-proof companies for utilities.
Yeah, that's interesting. I didn't know that.
Yeah.
So I
So
do have Nextera Energy, and it's not, I mean, as far as price movement, it's not moved much in the past couple of years.
uh-huh. There's been steady. Been a safe haven, probably.
Well, since you are looking at the PA ratios, I don't know. I pulled up, the oil sector ratio,
Uh-huh.
the median PE ratio for, for the energy sector is 16x.
Wow.
So
Well,
it's still pretty
uh-huh.
good, looks like.
Yeah, it's cheaper than
Although,
the S&P 500 17 times.
so that's another surprising data. Although Exxon has moved up, leading this sector up 56%, its PE ratio is still cheap.
Yes. So it feels like probably because of their earnings, in analysts are still expecting more earnings from these companies.
Mhm.
So it just means that their price right now is still cheaper compared to their growth. So
So
that's
that's a
something
good
to keep an eye
insight,
on.
something
Yeah.
to think about.
If you think on diving into the oil sector and think that there's more room to grow, it might be a good idea to have some exposure to oil. But yeah, so next chart we have here is the revolving consumer credit. So this is the credit card numbers. So as you can see here, during the lockdown, during the COVID, it actually dropped like a rock. And then now there's a U shape, literally a U shape forming here. And now we are seeing people diving into their credit cards to fund their daily expenses. As you can see, we're going to magnify closer to that U shape. Quite a huge drop in the early days of COVID lockdown, early months. But come July, but come January, look at that bottom right here, Wowie. A bottom of January 2021. And then consumers here in the US started using up their credit cards. Probably the use of buy now, pay later, right, Wowie? I
Yeah.
think that's the rise of the buy now, pay later. Even when I think it was Square who purchased that buy now pay later firm Afterpay for 20 something billion dollars last year, which is incredible valuation. I bet they're nursing their losses at this point in time. One company that reminds me of is the company called Affirm. At one point, I had this company in my portfolio, but I had to sell it because of a huge drop in prices. Like, there's no way it's gonna be like able to recover at this point in time. I think I still probably have a little bit exposure to it, but not a huge amount anymore. At one point last year, it was at $160 a share. And then from then, it lost almost 70% of its value, just going downhill, even losing 87%. almost 90% gone if you've stayed put in this company, which is a buy now pay later. So if we're gonna hypothesize, let's say, so Square bought Afterpay for how much? Let's see. They bought Afterpay for 29 billion back in August last year. So August was close to the peak of Affirm, and now we're gonna look at August. So they lost 78%. So 29 times, let's just say 80% loss. That $29 billion that Square invested in Afterpay lost nearly 6 minus 29, $23 billion in investment if Square is going to report a similar drop in valuation. So that's one thing to keep an eye on, because if that's the case, Square is going to definitely be reporting a huge upset in terms of its
Mhm.
balance sheet. So Square shareholders, just keep an eye on that. Retailers, so we're gonna see now the inventories to sales ratio. As me and Wawi have discussed a couple of episodes ago, Target came out with a huge disappointment, and Walmart too, with their inventories. Ross stores, we looked at that. TJ Maxx, I think the only store or company that didn't report a huge uh, increase in their inventory was Kohl's, right? Wawi, correct me if I'm wrong. I think Kohl's stuck up with their plan, and they have a good, at least inventory to sales figure at this point in time. Yeah. So for now, we're seeing a slow creeping up of the momentum in inventory to sales ratio. We're still at the lows for the past decade at least. There's still no troubling signs. As you could tell, whenever there's a recession, there's always a spike in inventory. So right now we don't see that quite of a ridiculous spike, but probably because this is on March data. But once we see a clear spike in the recent months, as me and Wawi already discussed a couple of episodes ago, that we might actually be already in a recession. So maybe this data right here, since it's just March, we'll probably see this might be a delayed recessionary data. What do you think, Wawi? And the inventory sales ratio.
Yeah, well, there's definitely a lot of inventory right now. I'm
Mm-hmm.
sorry, I have to change microphone. My headphones stopped working.
Uh-huh.
Um, so yeah, so we should it should determine, consumer sentiment. If we're still gonna see a lot of buying, and I still suspect there's still a lot of buying power from the consumer sector, but where it's gonna move depends on how much of this high inventory will start moving here in the next few months,
Right.
because we know Target is going to unload a lot of their inventory. And so that would be a good thing to watch, in my
Right.
opinion, is to see how confident consumers are in buying stuff.
Right. And
Um,
and right now we've just been closely monitoring the Michigan consumer sentiment as well. We're lowest in decades too. So sentiment doesn't really reflect what the consumer credit lines are doing, right? Well, because right now we're seeing a significant U shape right now. We're back at the peak prior to the COVID lockdown. So people are still
mhm,
spending. They're using their credit cards to spend.
mhm,
So despite the falling sentiment in consumers, people are still buying. And maybe, just maybe, this inventory overflow would now tamper down because of lots of discounts and markdowns, which then will reflect to the overall consumer price, which is going to go in a lower or on at least a dip. Um, but like what we just discussed, it's the housing market is slowing down, inventories are piling up. So these aspect right here indicates a broader slowdown in the economy already.
Mhm.
And the only thing that's putting now, in my opinion, the pushing up the inflation is the oil because of the war. So I think
Mhm.
once the sanctions kind of like tamper down, I think for sure there will be a sell off in the oil market, which would hurt the our only remaining industry that has been outperforming so far this year.
Mhm.
So that could reflect in the broader market again and more sell off it could entail. So
Mhm.
lots of things to consider. There are a lot like what Peter Lynch, one of the Wall Street investor, has said. Like there's things that would always make you worry about the stock market, but all you have to do is focus on the companies that you're invested in, and as long as their fundamentals doesn't change, you just continue holding them. So right now there are definitely hiccups in the stalwarts of Wall Street, like Walmart and Target. So
Mhm.
inventory wise. I
Mhm.
remember reading an article by regarding Walmart that they think it's going to take at least 2 to 3 months or 4 months even of inventory adjustment, meaning that they're going to, provide discounts on their inventory just so to catch up with the inflation. And also not with the inflation, but with their overstocking. So that's something to watch out for.
Mhm.
So for the past week, we're back in the downtrend, everybody. I thought last week we're slowly recovering because of the upside, but Nasdaq again regaining its crown as the biggest loser of the three indices. It's down 4.8%. S&P 500 down 3.8%. Dow Jones down 2.9%. Since for the past 3 months, Nasdaq is still the worst performer, down 7.5%. S&P is down 3.6%. Dow Jones is down 1.1%. And since the start of the year, Nasdaq is down 24.8%, more than the bear market. So earlier on, we have decided to include these stocks, their performance since the start of the year. So Berkshire, Wowie, back in February, we thought that the value versus growth is playing out. Berkshire is actually a good value hold since always
Mhm.
it's been holding like value stocks in the portfolio, and it's a good stalwart. So Berkshire is actually flat for the year, 0.00%. So it has done nothing
Mhm.
since the start of the year, interestingly. Exxon, it's up 61% since the start of the year because of oil prices.
Mhm.
And some companies that we're just going to mention. Carnival Cruise Lines. So this is the reopening place supposedly for the year for this year. It's down almost half, 45%. Zoom Communication down 40% since January. Tesla, they've been reporting very good numbers since the start of the year. They're still down 40% despite the
Mhm.
market expectation, the beating of market expectation.
Mhm.
DOCN, I think that's a company that you're invested in, right, Wawi?
Yeah, it's a cloud computing company.
Cloud computing company, it's down 39.8%. I think Snowflake is another company that's, cloud computing. Salesforce, which I have in my portfolio, it's
Mhm.
down as well, big so far this year, I think. Let's see. Salesforce is down 26.8%. So yes, even Adobe. I think Adobe is another good company.
Mhm.
It's a free cash flow generator, meaning that they generate a lot of cash because of their subscriptions, but it's still, let's see how big, it's down 24%, shadowing or imitating the overall NASDAQ. Logitech, which supplies computer keyboards and computers, down 33%. Target, down 33%. BlackRock, one of the largest, if not the largest asset manager in the world with over 10 trillion in assets, it's down 27.6%. Banks, JP Morgan is down 22%. Bank of America down 25%. Apple, the largest company in the whole world, well, now they've been surpassed by Saudi's oil companies,
Aramco.
Saudi Aramco, because they've fallen drastically. They're down. Apple is down 21.6%. Google, one of my favorites, down
Mhm.
20%. Walmart is down 16%. And interestingly, Chinese stocks are slowly recovering. Alibaba is down 8.7%. JD.com down 10%. Tencent is down 15%. So lots of companies that are still in the red. And as of yesterday, it looks like we're not done with the sell-off.
Mhm.
Ooh, that's quite a hard pill to swallow at this point in time, right, Maui? Lots of stocks in the red if you're gonna take a look at your portfolio.
Yeah. So even after a year, China is still doing COVID lockdowns.
Right,
Surges in their COVID-19 infection rates is still causing some factory shutdowns up to this time.
right.
And Tesla has stopped their hiring process at this time
Oh,
in
Tesla
China.
did in China, okay. But I think at least China now has slowly reopened, right, Maui? Some of the cities have reopened and traffic
Yes,
has now
they
started
have, but
recovering. Mhm.
they have closed certain sectors again,
Oh, okay.
certain regions again
Mhm.
after a recent uptick again in cases.
Cases. Wow.
So it's a it's a volatile uh, market still.
Mhm. Yes, for sure. So now going back to the mortgage or housing market, this was just published yesterday. Mortgage demand falls to the lowest level in 22 years. So average 30-year fixed mortgage increased to 5.4%. So this is way higher than last year. Because last year I remember, we were at trading at mid 2% or at least low 3%. Applications for mortgage now fell 7% and 21% lower than last year. And refinancing is down 75%. So not a whole lot of people that would like to get that high rate on their mortgages, obviously. In terms of global funds, fund flows, we always take a look at this too as well. So it says here global investors resume selling bond funds after purchasing them last week.
Oh.
Um, Interestingly, so investors pulled 9.46 billion out of bond funds after purchasing 7 billion last week. Let's see about stocks. Meanwhile, people are buying more money market, which is the safe haven.
Mhm.
The money market just experienced the best or the biggest inflow since last October at 56.6 billion inflow. Global
Mhm.
stock funds, wow, we are still showing inflow in global stock market. This is the third straight week of net buying after
Mhm.
attracting 1.9 billion in fund flows. Among the sector, utility and energy are the biggest recipients, but tech and consumer staples, let's see, they show the outflow, which reflects in in the performance this week. So let's see, emerging market funds. These are bond funds. So emerging markets saw outflow as well, nearly 790 million outflows in emerging markets. So not much going into markets. Now last week we kind of remember, right? While we that US and Canada receive a lot of flows compared to Europe, and then Asia
Mhm.
started showing some signs of inflows as well.
Mhm.
So 30-year mortgage, we're slowly increasing back up again. So just to keep an eye on, from May 27, the 30-year mortgage has now climbed up again from 5.25. We're at 5.50. So
Mhm.
25 basis points increase. So just a brief, snippets here from Target. So 3 days ago, Target came out with a warning that their profit margins will be taking a hit. Just to briefly summarize this article, initially they projected that they're going to earn at least 5% in their margins, but they had to cut that in half. They're now projecting 2% for the quarter, because of their inventory sales, which is coming up. So this might be a good bargain hunting season for those interested buying some stuff from Target. So Bank of America came out with a report a couple of days ago, downgrading Target because a recession may be coming. So the recession talk has not subsided. So we're still expecting a recession coming soon. But me and Huawei already think, we assume at this point in time that we're actually in a recession because of the negative GDP in the first quarter and yet to be reported second quarter in the coming weeks.
As we see Walmart, Target, trending down, you look at a stalwart like Costco, and it seems like it's a contrarian when
Mm,
it comes to when it comes to the retail market sector or consumer staple market
right,
sector.
right. It's incredible how Costco is holding up. I mean, that
It's
company
holding up good.
is a different animal for sure.
Hmm.
Probably because people go there in thinking that they need to really bulk up when they do their visits, right?
Hmm.
I remember every time I go to Costco, there's not a day that I spend more than $100 or less than $100 per visit. I always tend to end up with 2 bags of dog food because I have four
Hmm.
German Shepherds. Obviously, I have to have a lot of dog food.
It
And
offers good value.
yeah, I mean, I could buy a pedigree dog food over there for 55 pounds for $28. So I can't see that anywhere else except for farm stores, which I also go visit to. But yeah, I always see good deals in Costco. It's always quite tempting. And hundred
Yeah,
dollars for sure is like the minimum for me, if not a little more than that. And per visit.
yeah, I've been looking at Costco and Tractor Supply. It's like amazing. They're like going in the other direction
Yeah.
as Walmart and Target are going down.
Right. Yeah. Incredible stalwarts. So right now we have on our screen is the CME watch tool, which kind of forecasts. It gathers surveys from Wall Street, what they expect. So actually, by June 15, 5 days from now, Wall Street is expecting that the Federal Reserve would hike the rates not only by 50 basis points, not only by 1%, but they're looking at 1.25% to 1.50%. So this is quite interesting. Most of these Wall Street analysts think that the Federal Reserve is even going hawkish, more hawkish, despite the cool down in the housing already. So, some Treasury government bonds. This is 3 years. We're seeing the 30-year bond highest in the past 3 years. We're seeing the 10-year rate, 10-year note, the highest in the past 3 years. We're seeing the 3-year note, the highest in 3 years. So, and like what you said, Wowie, one thing that's better to look at as is the flattening, if there's any, on these data,
Yield curves.
the yield curves. So that's one thing to definitely keep an eye on. So right now we're gonna take a look at another slide. Oh, sorry about that. I got my dog inside. So Max. So we have Kathy Wood. This is an article from Seeking Alpha. Kathy Wood has seen nearly 50% of her assets vanish this year across all 9 ARK in ETFs.
Mhm.
So this is nitpicking on Kathy Wood's high growth approach in the next generation investment that she brings into the market. So ARK Innovation is down 54. This is as of June 7th. So this is even before yesterday's sell-off. So this could be even lower. So most of her funds lost nearly 50% since the start of the year. But still, fund flows are coming. to ARK Investments.
Mm-hmm.
So people still believe that she can turn it around after losing half of their money. So that's one thing to keep an eye on. The sentiment is still bullish when looking at Kathy Wood's performance so far this year. So we haven't
Mm-hmm.
really seen like very, very like negative, like big money pulling out of her funds, despite the incredible underperformance
Mm-hmm.
um, of her ETFs. So Goldman Sachs coming out of like a prediction says energy is in the early innings of a decade-long cycle. So we're Goldman Sachs is seeing even more uptrend
Mm-hmm.
in
Yeah,
terms
just
of
looking at its
oil.
valuation, right?
Mhm.
I just looked at its PE and it's lower than the S&P 500.
Right.
Wow. So that's a surprising
There could still be
data.
more
I
upside.
didn't know.
True. So if this conflict in Eastern European is still ongoing, then there could be a chance that the market, oil market particularly, would climb up even more from here. So on the other hand, this is what we talked about earlier. So ECB, European Central Bank, came out with a bigger bigger move. Well, it kind of said yesterday that 25 basis points is the amount that they're going to hike up for July, for next month. And then September, they'll probably hike even bigger. So this is quite a hawkish stance. So that's one thing to keep an eye on as well, in not just looking at the US market, but also in the European market. So we're right now we're recording pre-market. For those who have stuck with us until now, thank you guys for tuning and appreciate the follow. So right now we're recording a pre-market, so we're just looking at the pre-market sentiment. Dow Jones is down. Looks like everybody is down pre-market today, down 56 points. Nasdaq, I take my word back. Nasdaq is up 24 points pre-market. But before we kind of like take a look at these pre-market numbers, and it kind of like dictates what the market would end up doing at the end of the day. But right
Mhm.
now it's been volatile. So it can be negative pre-market, but it'll be up at the close. Or it could stay negative all throughout. So Wowie, before we end this episode, do you have a quote for the week for our listeners?
I do from Bo Derek. She
Uh-huh.
said, whoever said that money can't buy happiness simply didn't know where to go shopping.
So you do think that money can buy happiness at a certain period of time, right?
Yeah. Well, if you're happy when your money goes up, you better figure out where to put your money.
Right. So maybe right now, Wall Street is expecting that people will be spending more on services like taking trips, flights, hotels, and
Mhm.
reservations compared to last year's trend where they're buying home goods or home improvement products. Do you agree, Wami?
I agree. This is the
So
time to travel and test out the waters.
I agree with that. Sometimes it pays to be, to spend some time out of work and just to, you know, absorb nature.
Mhm.
Well, Wami, I think that'll do it for today's episode. And thank you so much for coming on.
Thank you so much, Mark. I
And
think
uh-huh.
we need to keep up with our market analysis by company. I think that's good.
Right. Well, so far we're expecting a steady performance this day, and hopefully we end the week in a positive note on our stock market. Well, listeners, I guess that does it for the episode of Mark Yu and Wawi Show. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
And this is Wawi Santos. Thank you to everyone listening.